People are starting to ask me about a bubble. It's not a bubble. We're not in a bubble. If we're in a bubble at all, we're just beginning a bubble. And the first thing to do whenever there's a bubble is to get in it early. The bubble is around gold and silver, and the bubble is collapsing. Stocks are on the skin of the bubble. And when the skin collapses, when the skin breaks, the bubble collapses, all that will be left is things that are real.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. It's Wednesday, September 25th, and this is the market rundown. The headline is 10 Daily Silver 5% rally. We'll be talking about two things today. First of all, silver in various places. Topically, China's bazooka fires silver bullets. And the other part of this, we're going to talk about the 1970s parallels to what's going on right now. Now, this is a topic that many doomers talk about. Certainly, we were one of the earliest to talk about it in terms of the second or third peaks in inflation back in 22. And around that time, we had come upon a long lecture by Arthur Burns, the outgoing chair in 1979. And he gave a lecture that was shocking. Shocking because everything he said in it has a parallel to today. And so one of our earliest thorough write-ups was on that topic. And we're going to go through it again today, at least in cursory fashion, because the 50 basis point cut just puts us back on that path. Whether you think Powell is capitulating or not is irrelevant in terms of what's happening. He may think he's not capitulating, but behaviorally he is. Okay, so let's go to that. Let's start with the markets themselves. I'm going to leave this up here for now. The dollar is 100.44. Technically speaking, I think it's hovering right above a ledge. 10-year yields are 376, up 3 basis points. The twos and tens continues to steepen. The SP 500 is 57.33, down 2 handles. The VIX is 15.65, up 27. Gold is 26.56, closed, traded, new all-time high yesterday, down less than $1. Silver, 31.88, down 20 cents. Not even much of a pullback at all, actually. Copper, 444, down 1.25%. Gold, silver, still really high. Okay, but we're in the process of cracking that. WTI 71.46, natural gas 2.54, Bitcoin 63.800, Ethereum 26.42, platinum is 9.89, unchanged, and palladium is down 16, 10.45. Okay, that's a dangerous trade. That's the lesson there. Soybeans down 11 cents, 10.46. Corn 3.98, down 3 cents. 5.81 wheat, down 2.7 cents. The chart you're looking at there is something that I'm now interested in for silver. It's down the road. It's not something you're going to be looking at daily, but if you have anyone, if you see anyone talking about it and you want to learn a little bit more, pay attention. The topic is physical tightness. Physical tightness precedes bigger rallies in silver, often leading to what people call short squeezes. Now, there are two ways to see fingerprints of this happening, and one way is to look at the EFP, which we will look at. We'll discuss another time, and the other way is to look at this, and this is very simply the red line and the blue line are supposed to move in the same general direction. Okay, so the blue line is the actual market itself. So when spot silver rallies, the red line, we'll say what that is in a second, should rally with it. When spot silver drops, the red line should drop with it. The only time those two should diverge for any meaningful length of time is in one of two situations. One is when interest rates are being changed, which they were just changed. So that's a factor that I'm thinking about. When interest rates are changed, the red line, again, I'll describe what that is in a second, should change its relationship to the blue line. And the other one is the one we're interested in. The other one we're interested in is when the red line starts to diverge from the blue line. So in this case, when the red line is going down while the blue line is going up, that is a sign, an early sign of physical tightness. That is a sign of there's not enough metal easily or readily available to make delivery. If one is called for, fears of delivery are increasing, and therefore you will see this thing happen. Now, what is this thing? The red line is December-March future spread on the COMEX. As the market rallies, the red line should rally, meaning March should rally more than December. As the market drops, March should drop more than December. That's just mathematics of interest rates, cost of carry. When those things don't happen or don't happen sufficiently enough, that's a sign of either too much or too little metal in the market. Now, there's rarely too much in the market. So I think we could be seeing the beginning of some legitimate physical tightness, which would be odd considering that the warehouse has been filling up. Another time on that, but just it's on the radar now. So I'm looking at it. And if it happens, we'll all talk about it together. Here's silver. All right, it held that level I talked about before. This again, this top just wasn't a problem, right? It's not a problem. This was not a problem. What is it? 30, 30, 30, 50, right? Once we got above 30, 30, 3150, 3150, sorry. Once we got above 3150, it's just not, it wasn't a problem. Okay, that was not a real high to be put in. And so here we are, healthy bull flag, 5% rally, and we'll come back to this in a second. Let's go on with we have a lot to talk about, so let's talk about it. Okay, front page, Goldman Silver Bullet comes out the day of the rally. China's bazooka laying out the reasons that it should rally. Tuesday's PM post, those are all the posts we put out today. We put out 5 yesterday, 3 on precious metals, and we're going to discuss this post a little bit here. All right, news and analysis. Yesterday, Chris Marcus at Arcadia Economics was interviewed by Craig Hemke for Sprott, and well, it was a really good interview. Okay, Chris touched on the fundamentals of every topic, and as is typical of his tone, he spoke like an adult who wasn't going to use superlatives or anyway, it was very good. He touched on the dynamics in gold and silver, highlighting the record short positions and their potential impact on prices. He notes that increased buying from BRICS nations and technological advancements like new EV battery tech could drive future silver demand. Could. Now, we know it will, but he's just not going to say could. Marcus also points out the challenges of maintaining production costs under $25 per ounce in silver, which could constrain supply and support higher prices. All valid, important points that are underpinning this whole market. Which brings us to silver itself. China's bazooka fires silver bullets. All right, here's the chart. So there's yesterday. All right, so China releases its half of its bazooka. It's only half, okay? Geared towards rescuing their stock market. And it does, at least for a day, the shock value. And I wake up in the morning and gold is unchanged. And Silver's up 20 cents, and copper, I think yesterday, if you watched yesterday's show, copper was up 4%. I was like, holy shit. Um, so there was some bleed into commodities in the industrial metals fashion. Industrial metals get bought first. But I was quite frankly surprised at the move in copper. And you could see it here. It happened right away, right? Uh, and silver was up 20 cents. And I said, okay, well, silver is bouncing because it got slammed the other day. No big deal. And then, boom, lo and behold, we just zoomed higher the rest of the day. And silver, I think, just basically said, no, you don't, to copper. And so Dr. Copper meets Professor Silver, and that's the tail of the tape. So what happened there? Among other things, the Chinese stimulus puts money in the market. They're going to buy stocks. They're also going to buy stuff that makes the money before. They're also going to buy stuff they know can move higher quickly. And so at some point during the day, they said, let's buy silver. And then in the US, to make things worse, if you're short, silver got bought after consumer confidence came out. Consumer confidence came out actually very bad. And now we're at the point where the market stocks specifically are looking at consumer confidence saying, oh, consumer confidence is weak. Oh, then the Fed can cut another 50 basis points. So we're in the greed mode in stocks. And you could say that about silver, except no, because gold's not in greed mode. Silver's just playing catch up. This is the time. People are starting to ask me about a bubble. It's not a bubble. We're not in a bubble. If we're in a bubble at all, we're just beginning a bubble. And the first thing to do whenever there's a bubble is to get in it early. Speculatively speaking, this is not a stacker's comment. We're not in a bubble. The bubble is around gold and silver, and the bubble is collapsing. Okay. Stocks are on the skin of the bubble. And when the skin collapses, when the skin breaks, the bubble collapses, and all that will be left is things that are real. Okay. Enough with the lecture there. Where did that story go? The Volcker thing. I'm sorry for the scrolling. I screwed something up here. I'll touch on it quickly for the interest of time. There are spooky parallels between the 70s and now. Arthur Burns was chairman of the Board of Governors of the Federal Reserve System from 1970 to 1978. The paper referenced in the article that I wrote then and included at bottom is a reprint of the address Dr. Burns gave as the 16th Per Jacobson League lecture at Belgrade, Yugoslavia on September 30th, 1979. In October 79, Fed Chair Paul Volcker announced new measures by the Federal Open Market Committee aimed at reining in the inflation that had afflicted the U.S. economy for several years. Spelling is not my strong suit. In his lecture, Dr. Burns goes through some of the reasons, drivers, and likely explanations why things got out of hand. All right, and then I say it again because it needs to be said again. Here's what he said. There's the story, there's the report. Here's what he said then, 1979. Central banks can't stop politically driven inflation. They have the tools, but not the will. Something that we all feel. Fed had tools to stop the inflation, but chose not to use them because it had been caught up in the social movements of the day. DEI, woke, full equitable employment. Not saying they're not honorable things, just saying they're just not doable in that position of government. There was a nationwide desire for a more interventionist government. Help us. That was in the 70s too. I lived it. There was a concern about unevenly spread prosperity in the 70s, just like now. There was an overwhelming goal of full employment by the Fed. Everyone needs to have a job, but not understanding what the appropriate level of, quote, full employment was. Employment is a dynamic equilibrium model. It's not static. Moving on. And I can't believe this, but these words are like coming out of his mouth in 79. Environmental policies added to the inflation. bureaucracy, unreasonable goals made us shut down nuclear reactors and stop progress economically for noble reasons. But there's a byproduct from that. Okay, here's number 8. Entitlements diminished the work ethic. In other words, he says it in there, is that once you get a person on an entitlement, it's hard to get them off because it's what's the word? It's inertia, right? So people on welfare don't really have an incentive to go off welfare. People getting stimmies really don't have an incentive to go off of them. 1979, he said this. Inflation was fed by high unemployment, deficits, and money creation. Now, the difference between now and then is we don't have high unemployment, yet we're going to have high unemployment. It's UBI is going to happen. And then number 10, he ends his lecture by saying in 1979 that this will and already has begun to lead to a conservative political movement. Now, when that lecture was over in September, Paul Volcker left, went home, and less than a month later started to raise rates to just destroy inflation and the economy and the middle class too. But that's not the point of this. The other point I want to make is in sympathy, in camaraderie with those people who really, really don't like this guy, Burns. Where's that picture? Is that picture in there? I left the picture out. I didn't like him that much. The Look, Arthur Burns in 1979 was lecturing everyone on how hard it was to be independent as a Fed chair after he left office, after he capitulated. He was rewriting his own reputation for not having the will. He even said it. He did not have the will to do it. And in doing that, he gave Volcker cover to do what had to be done. Anyway, moving on. Data on deck, more cuts are expected because of what happened yesterday. New home sales in August, probably going to do well. GDP Thursday and Friday, we have PCE. All right. A little special bonus at bottom for premium subscribers. A quick check on the markets again. Let's see what's interesting here. Oh, I want to look at this. Go to the weekly. There we go. Okay. So we're out of it. We're out of that channel. Now, I prefer to look at the ledge that comes in here now on the daily, right? It's like a breakdown from there. It's a break up from here. It's a stop and it's a stop. Below this line, we could run. So you're crazy to be short gold. You're crazier to be short silver for the next 2 weeks to 2 months. All right. I'm Vince. Have a great day.
Thanks for watching this morning's Markets and Metals with Vince Lanci, brought to you each day by Miles Franklin Precious Metals, where this week's specials include 2024 American Silver Eagles for only $5.25 over spot, and 1 ounce gold Argo Heraeus Dragon bars for only $69 over spot while supplies last. Find out more, send us an email at arcadia@milesfranklin.com or call us at 833-326-4653. And as always, thanks for watching. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.